United Health Group has dropped significantly today and is down over 17%. Over the past year, this company has dropped almost 50% since its all-time highs, which begs the question, is this company a good buy at this price? Now, I'm just going to mention that I think a lot of YouTubers make this mistake where they look at a company like United Health and they see it drop 15-20% and they instantly buy it. But the problem is they don't look at the underlying fundamentals of the business to see if it's worthy of a long-term hold. So all the companies I buy, I want to be holding these companies for the long term. And what that means is the fundamentals of these companies need to be strong, and these companies need to be increasing in intrinsic value just to warrant holding them for such a long period of time. And a company like United Health, for example, if the fundamentals are not strong, I will probably be selling out of this company in the next 3 to 5 years, which is not something I want. Because all the companies in my portfolio up to date are extremely strong, fast growth, and monopolistic companies, and I want to have companies like that in my portfolio. So just because a company dipped down even 50% on the year, that doesn't automatically warrant that it's a strong buy. You have to really look into the company and dive deeper to understand each fundamental. So with that said, I'm going to actually dive deep into United Health and do a full analysis on the business. And then I'm going to tell you if I think I'll personally be buying this company or not. So to start off, I'm using an application called Stock Unlock. This is an application I really like, and I'm not sponsored by it, but I would recommend you checking it out because it's quite good. And looking at the insights of this company, I could actually see that it has a pretty decent rating. It has a rating of 3.88, which is not bad. And if I go to the insight tabs, and this is a feature I really like about Stock Unlock, is it just gives you a big summary of all the metrics that are important. So what I'm noticing now is that the profitability is actually quite low. So you have an operating margin of 8% and a net margin of 5%. And this is a margin that is quite low. It's compared to big tech or any other big company, that's actually a really low margin. Obviously, this is an insurance business. So in insurance, you have lower margins. It's just how that business works. But I personally try to avoid businesses with such low margins. So going into the financials now, visually I could see that obviously the financials have just been increasing year after year, which is quite good to see because that means that this company is basically a compounding machine with these earnings. So I could actually also see that they seem to be buying back a significant portion of shares. So ever since 2006, they had a share buyback program in place where they just continuously bought back a bunch of shares, which is always nice to see, especially now that the business is priced at a significantly lower multiple than it was historically. It's nice to see that they're buying back shares. I could also see that the free cash flow generation has been quite good. So going back all the way to 2004, all the way up until now, the free cash flow has just been increasing. It had some dips recently. I'm noticing that in 2024, it had dipped down significantly, but it seems to be growing again. So that's nice to see. Of course, we get to the metrics of the business. Now, this is arguably the most important part of the analysis process. So you just I like to look at just what their return on equity is, what their return on invested capital is, because I want to invest in businesses that have a strong return on equity and return on capital. And I want businesses that obviously create a lot of value for the shareholders. So I'm looking here and I see that the return on equity is quite high. I see it's around at 15%, and I see it has some peaks at, 25%. So it seems to have very high return on equity, which is nice to see. The same could be said about their return on invested capital, which also has quite high rate. It's hovering around the 20% mark. And of course, looking at the net margin, like I said, they're quite low. And for this reason alone, this business doesn't appeal as much to me just because a lot of the businesses I own actually have insanely high net margins. So if you take like Visa, for example, like Visa has like a net margin of around 52%. So that's insanely high compared to like a company like United Health. So I always try to look for companies like Visa that have these insane margins and these margins that could be like cut in half and they still would be good. Like these metrics here that Visa has, these metrics could be cut in half and they're still extremely good metrics. And even the growth is a lot higher than United Health. So what I'm trying to say is that even if United Health is on paper a decent quality business, if I'm looking for a business, I obviously want some of the best businesses in my portfolio. So that's something to consider. That's a point I find a lot of YouTubers actually miss. And it's that, like, going back to United Health, you have a good company on paper. I would consider it a mediocre company. The growth is okay. The fundamentals are okay. There's nothing wrong fundamentally with this company. But what I notice is if I was to choose to hold United Health for the next 20 years, or if I was to choose to hold a company like Visa for the next 20 years, I would instantly choose Visa. And even if United Health Group has dipped down and it's at a relatively attractive price at this moment, Visa is just superior in every way. Like, these margins are superior. Everything about this company is just superior. So then it begs the question, at what point do you decide that United Health is worthwhile to invest in for the long term? And at what price would that be? Obviously, you're going to be paying a lot higher multiples for a higher quality company like Visa, but at what point do you decide if it's worth it? Now, going back to the metrics of this company, obviously this company has a decent amount of debt, so that's something to consider. I personally like to invest in companies that actually have no debt at all or minimal debt, because I feel like that helps grow their free cash flows and that helps grow their intrinsic value over time. And it's also very hard, like Peter Lynch says, it's very hard to go bankrupt if you have no debt, right? So the company also pays a dividend. It pays a dividend yield of 2%. So that obviously is going to slow down their growth just because they have a dividend that they're paying to shareholders, and they're paying out a ratio of 41.93%. So it's still, it's not that high, but it's still significant. So going back to my checklist, does United Health have a competitive advantage or a moat? And I'm going to argue that it does have a moat, but the moat is not as strong as you might think. So you obviously have the scale and market dominance of the company. The company is a huge company. I believe it's the biggest in its sector. So it's just a huge company. So obviously has that dominance, and companies are going to most likely pick that insurer over competitors. So there's that contributes to the moat. There's obviously network effects, again, scale. And I put down diversified revenue streams, but the reality is 99% of revenue from United Health actually comes from the United States. So what that means is that if healthcare, for example, would change in the United States, or they decide to cut costs on health insurance, or some government agency decides to change some laws regarding healthcare, that could significantly affect this company. So I would argue that although United Healthcare does have a lot of clients, they're all within the United States. So the revenue is not as diversified as it may seem. And I'm actually going to remove this one from the moat because I don't think it's actually a competitive advantage at all. And then of course you have switching costs. So I don't think I need to explain that one, but it costs a lot to just switch your healthcare provider. So that gives United Health Group a significant advantage over others. And there's also a situation where literally every American citizen just hates this company with a passion. And that's to be expected because health insurance has this negative reputation of just being the worst industry in the entire world, basically. So there's that to consider too when investing in it. And that could also warrant it trading at a lot lower of a multiple in the future. And just going down the checklist here, does this company have growing earnings? And I would argue no, the earnings are significantly slowing down now. They actually only grew 8% this year. And compared to some extremely high quality companies that are growing at around 10 to 15%, I feel like that earnings growth is a bit slow. Free cash flows have been growing, but they've been a bit unpredictable recently. So I'm just going to put this as a okay. It's just okay. There's nothing special about it. Now, strong management, I would say the management is okay. There's nothing special or bad about the management. They do buybacks. The return on invested capital and return on equity is okay. They seem to be managing the company okay. So healthcare is not cyclical. It actually is very resilient to downturns, which is a good thing. So if you're thinking of investing in this company, that might be a significant positive for you. So now we get the price. And I'm going to do a discounted cash flow analysis on this company. I'm going to use the metric of net income to earnings, and I'm going to assume some very conservative metrics. So just to give you a bit of perspective, United Health Group has been growing at 8% this last year. So I'm going to use the metric of 8%. I'm also going to assume they buy back 0.93% of their shares, which is the average of the last 5 years. The dividend growth rate, I'm going to put it at 0%. I'm just going to assume the dividend does not grow. Again, trying to be very conservative. And I'm going to put a price ratio of 20. Obviously, this company is high quality, but there is some headwinds in the future and it has a very negative sentiment in the community. So I feel like a price ratio of 20 seems to be fair. And assuming all these metrics, we get a compound annual growth rate of around 20% with a fair value of $490. And assuming over the next 5 years, these metrics continue to grow, we would get a future stock price of around $747. Now, we could even be more pessimistic with these numbers. We could input a growth rate of around 6%. And this would make the compound annual growth rate of around 18%, which is still very good. These are market-beating returns. And let's just try to lower the metrics to see what is being priced into this company right now. So even if we have a metric growth rate of 0% and the shares outstanding being bought back at 1% a year with a price ratio of 20, we still actually have a compound annual growth rate of 12%, and that just shows how undervalued this company is. So this begs the question, am I going to be buying United Health Group at this price? And the answer is no, I'm not going to be buying this company. And there's a few reasons for that. So first of all, United Health Group is a strong company. It is a good, high quality company. But in my portfolio, I have a strict rule where I only buy the best of the best companies. And although United Health Group is very strong, it is not the best company by any means. I want to buy companies in strong sectors that provide value to their clients. And I want to buy companies that grow their intrinsic value per share and compound over decades to come. And United Health Group just does not meet these characteristics. The margin is low, the growth is mediocre, and I just don't like the sentiment on this company at all. I'm sure this company will outperform the market in the long term, and I'm sure that many investors that bought into this company today will have significant returns going forward. But to me, this company just doesn't meet all my qualifications for being a compounding machine, and for that, I'm not going to buy this company. And when you run a portfolio like mine that has only 8 to 9 companies in the portfolio, you have to really be selective on what companies you want to add in. And all of my companies have significantly higher margins and just have all around better fundamentals than United Health Group. I hope this helped, and I hope everyone has a great day.